Your 40s are dangerous because your mistakes stop being temporary. In this decade, one financial mistake does not become a lesson. It becomes a long-term anchor that follows you for years. Today, we are auditing the hidden money traps quietly keeping middle-class high earners stuck. By the end of this audit, you will see exactly where your financial flexibility is collapsing and how to take control before the damage becomes permanent. Most people think their 40s are the decade of stability, but weak financial systems become permanent here. Let's assume you earn a comfortable salary. At 25 years old, a $500 mistake feels survivable. At 45, that same mistake compounds into delayed retirement, lost flexibility, and years of stress because time matters more than income now. This is also the decade where sandwich generation pressure becomes real. You may support aging parents while still helping children financially. If your paycheck is already locked into fixed costs, one disruption can collapse the entire system. When your margin disappears, every problem becomes expensive. Many people look financially successful from the outside, but the entire system only works as long as the paycheck keeps arriving every 2 weeks. The moment income pauses, the illusion breaks. Lifestyle inflation becomes permanent in your 40s. A nicer apartment, better car, vacations, and upgraded living standards stop feeling optional. Every raise quietly increases your cost of existence. Your mortgage grows, your subscriptions multiply, your vacations become expected. Eventually, high income no longer creates freedom. It only funds maintenance. Lifestyle inflation feels normal because after decades of working hard, people believe they earned the upgrades. The danger is that it rarely feels reckless in the moment. It happens slowly, through slightly bigger payments and recurring bills. Then one day, your entire life requires a massive paycheck just to stay operational. The fixed rule is the 50% raise split. Every time your income increases, only allow half of the raise to upgrade your lifestyle. The other half must automatically build flexibility and financial margin immediately. Look at your last salary increase or bonus and calculate what half equals monthly. Then automate that amount into a separate account before you can spend it. Defaults beat willpower because systems remove emotional decision-making. If your paycheck increased by $400 monthly, automatically move $200 into savings or investments every payday. Your lifestyle still improves, but your financial flexibility improves too. That is how you avoid becoming a high-income prisoner trapped by expensive maintenance disguised as success. At some point in your 40s, many people open their retirement account and panic because they realize they are behind. Panic changes behavior. Suddenly, boring investing feels too slow, and people start chasing speculative stocks, crypto moonshots, aggressive leverage, and guaranteed opportunities. Not because they are greedy, but because they are scared. Taking excessive investment risk to catch up is one of the fastest ways to permanently damage your future, because losing money in your 40s hurts differently than losing money in your 20s. Retirement anxiety feels normal because risky investing feels proactive and exciting. People convince themselves they need one big win to fix everything quickly. But financial survival in your 40s is usually built through consistency, not dramatic wins. The fixed rule is the boring baseline rule. Increase contribution rates, reduce unnecessary spending, automate investments, stay consistent. Delete at least one high-risk trading app and increase your retirement contribution even slightly. Small, permanent improvements matter more now than emotional swings and adrenaline-driven decisions. This trap destroys more people than most realize. On paper, they look wealthy with a nice home, retirement accounts, expensive cars, and a strong salary. But in reality, they have almost no accessible cash. Their paycheck enters the account and immediately disappears into mortgage payments, insurance, tuition, debt, and subscriptions. Their bank account becomes a transit station. The trap is having high net worth but no survival cash. Assets do not always create flexibility. Liquidity creates flexibility during layoffs and emergencies. High earners often assume income equals safety until the income suddenly stops. Then they discover their entire system depended on uninterrupted paychecks. That is dependency, not stability. The fixed rule is the 6-month liquidity floor. Your survival money should exist outside the market, outside home equity, and outside retirement penalties. Add up your true non-negotiable monthly expenses and multiply them by 6. If survival costs equal 5,000 monthly, your liquidity goal is 30,000 sitting in accessible savings because liquidity buys time. Your 40s often become the decade of financial responsibility overload. Parents may need help, kids may still depend on you, medical issues appear. Suddenly, everyone depends on you financially, and you become the emergency fund for the entire family. The trap is sacrificing your own retirement security to rescue everyone else emotionally. Support usually comes from love, but love without limits creates financial exhaustion. Temporary support often becomes permanent expectation, and many people quietly destroy their future trying to preserve everyone else's comfort. Helping others feels morally correct, which is why this trap becomes dangerous. The fix rule is the oxygen mask protocol. Protect your own survival first because nobody benefits if you become financially unstable too. Support should include boundaries, limits, and rules instead of emotional improvisation every month. Decide the maximum amount you can realistically provide without damaging your future. Instead of fully funding an adult child's lifestyle, cover essentials only while requiring them to handle entertainment and unnecessary spending themselves. People think financial collapse comes from one giant purchase, but it usually comes from dozens of recurring monthly obligations stacking on top of each other. Fixed costs become invisible because they are automated. You stop questioning them. The trap is building a lifestyle with obligations so high that quitting your job becomes impossible. Mortgage payments, SUV loans, subscriptions, private school tuition, and recurring shopping quietly remove flexibility one payment at a time until your paycheck becomes life support for your bills. Automated payments create emotional numbness because you stop feeling the spending happening silently in the background. But every recurring bill reduces your future choices. The fix rule is the subscription and debt audit. Print your last 3 months of bank and credit card statements. Highlight every recurring payment and ask one question. If income disappeared tomorrow, would you still choose this expense? Cancel unused memberships, downgrade premium plans, and remove unnecessary subscriptions because small recurring cuts create massive long-term breathing room and flexibility. This trap looks successful from the outside. Good salary, nice benefits, stable career. But internally, you feel trapped because your lifestyle now requires the stressful job. The trap is trading your physical and mental health for income because your expenses became too high to escape. Society rewards overwork, so people convince themselves the stress is worth it. They keep surviving year after year while burnout quietly compounds. In your 40s, your paycheck can become life support disguised as professional success. The fix rule is the freedom fund target. You need the ability to survive career changes before you desperately need them. Calculate the exact income difference between your current stressful job and a lower stress alternative you would realistically accept. That number becomes your freedom gap. Then lower expenses and increase savings until the transition becomes possible. If a healthier job would pay 2,000 less monthly, your mission becomes reducing obligations by 2,000. Flexibility is one of the most valuable financial assets you can own. In your 40s, debt often becomes socially invisible because everyone around you has payments. Car loans, renovation loans, HELOCs, and credit card balances become normalized behavior. The trap is treating consumer debt like a harmless tool instead of a constant drain on future income. Debt reduces flexibility because every payment steals future options. Normalized behavior is not always healthy behavior. The fix rule is the zero debt inventory. You need complete visibility because vague debt feels manageable, but specific debt feels urgent. List every debt you owe outside your primary mortgage, including interest rates, balances, and minimum payments. Then sort everything from highest interest rate to lowest. Take small savings from canceled subscriptions and redirect them automatically toward high-interest debt every month. Debt survives through randomness and emotional avoidance. It dies through systems and visibility. Many people stay trapped because they never fully confront the numbers directly. The moment debt becomes measurable, it becomes actionable instead of emotionally invisible background pressure. In your 20s, you could neglect sleep, eat badly, and recover quickly. Your 40s work differently because neglect begins charging interest. The trap is sacrificing long-term health to maintain short-term productivity. Poor sleep, stress eating, constant delivery food, skipped appointments, and ignored symptoms compound quietly over time. Busy people prioritize output over recovery because maintenance feels inconvenient. But health problems in your 40s are rarely cheap financially or physically, and your body eventually becomes part of your financial system, whether you like it or not. The fixed rule is the preventative maintenance plan. Maintenance is cheaper than repair financially and physically. Schedule overdue appointments now, including physical exams, dental cleanings, blood work, and preventative screenings. Remove the delay. Instead of ordering expensive delivery lunches during work, spend a few minutes preparing simple meals at home for the week. Less money wasted, less stress accumulated, less long-term damage later. Preventative systems matter because your future financial stability depends heavily on your future physical durability too. Many people in their 40s avoid administrative financial tasks for years because they feel boring instead of urgent. Wills, insurance updates, beneficiaries, and retirement allocations get postponed repeatedly. The trap is delaying important financial decisions until a crisis forces action. Crises never arrive conveniently. The fixed rule is the admin hour. You do not need motivation. You need scheduled maintenance. Block one uninterrupted hour this week, specifically for financial administration with no distractions, no multitasking, and no excuses. The most dangerous trap sounds harmless. There is still time. That sentence quietly delays action for years. The trap is assuming your future self will become more disciplined later. But later arrives much faster in your 40s. And compounding windows do not stay open forever. Retirement still feels distant and abstract, so people postpone serious action mentally. But your remaining working years are becoming countable now? The fixed rule is the 10-year urgency rule. Start measuring life in remaining paychecks instead of decades. Estimate roughly how many paychecks remain before you want the option to stop working full-time. The number is probably smaller than you think. Write something like 180 paychecks left on a sticky note and place it where you see it daily. Not to create fear, but to create clarity, because awareness changes behavior. Most people think their 40s mean they finally made it financially, but this decade is actually a stress test where systems either become durable or permanently fragile. Real wealth in your 40s often requires living below your income more intentionally than you did in your 30s, because flexibility matters more now. This is no longer about looking successful. It is about surviving disruption without collapse. Financial problems in your 40s are rarely pure income problems. They are systems problems. If you do not control the system intentionally, the system will eventually control you. Pick one trap from this audit and fix it before the end of this month, because durability matters more than appearance now.